All right, welcome everyone. Thanks for your patience on the start of Macro to Micro Power Hour. Again, Samantha LaDuc. I am founder of LaDucTrading.com. I'm joined with our macro advisor, Craig Shapiro, so we can talk all things macro, also answer questions right down to the micro. Obviously, I run a live trading room. We've got a very full bench, a bevy of analysts and traders across all asset classes and time frames. So we've got lots that we cover. But in particular, we kind of like to open this up every once in a while and do this session so we can answer your questions. So it's definitely an Ask Us Anything type of format. But first, I think, and foremost, I would love for Craig to catch us up on the debt ceiling risk being pulled forward. And specifically, you can see the kind of market gyrating on this as the very short duration yields are popping strongly higher. So on this kind of risk aversion. So catch us up, Craig, on debt ceiling risk.
Yeah. I mean, regrettably, I've had to spend an inordinate amount of time trying to figure this out and kind of understand the political dynamics on both sides. As it turns out right now, negotiators are at the White House speaking, and McCarthy is speaking on Fox Business with Larry Kudlow. So, there may be some headlines here, as we're moving about. But look, ultimately, I think we're in a situation where both wings of the respective parties are pretty entrenched in their views, and so you have a far right wing that says we've passed a bill, we elected this speaker, and there's really no reason for us to move materially off of where we are. And then you have a far left liberal wing of that party says we have an agenda. We've been doing this for 2+ years, and there's no reason for us to kind of, negotiate with, for lack of a better word, domestic terrorists. And so, both sides, it seems like are sinking into their positions. And I think one of the issues that has arisen is that Yellen has kind of articulated this June 1st as an X date, which is the date that she claims will be such that the Treasury really has much less ability to confirm that it will be able to make all of its payments for interest, for expenses, for whatever. And I think most of the numbers and most of the modeling that I've seen suggests that that is actually not true. Treasury will still have between $20 and $25 billion on June 1st. And it's more likely that there is risk to the Treasury's checking account kind of getting further depleted in the second week of June, really more in the June 6th through June 9th range. But even then, most models suggests kind of no worse than $10 to $15 billion. So we're really not, it doesn't seem like, in a position where the Treasury is actually going to run out of cash. And what I've been saying, and what I think most people realize, maybe they do, maybe they don't, is that if we could just get to June 15th and not run out of cash, then there is an influx of corporate tax payments that will come due, and companies have to make their second quarter tax payment. So that will bring in some cash. And it is likely to be enough cash to offset the rest of the expenses that need to be paid for the month of June, which then gets us to June 30th. And on June 30th, there are further extraordinary measures that the Treasury can take to allow them to raise even more short-term debt in order to kind of fund the government. They should, I believe, have an additional 100 billion or so capacity to issue further debt, which will then allow them to last for another 4 to 6 weeks. So and I know it's a bit much, but so I think what I'm trying to say is that if you don't believe that Treasury is actually going to default soon in the next 2 to 3 weeks, and that is the powers that be that are in the room that are doing the modeling at Treasury or wherever are saying, we're not going to default. Like, if we're not going to default, let's dig in here. Why are we trying to get to a deal now? Let's table this again into July, August. And we'll kind of have to, see where things go. And so I think the progressives are basically coming in saying, let's just, if all it takes is us getting to June 15th, Biden, do something about it. Find some money in the couch cushion, or, threaten the use of the 14th Amendment, or just keep doing it. And then once the court has to make a judgment, well, we'll already have the cash in place. And then, it won't really be such a big deal. And similarly, the far right is saying, Janet's, the Treasury is lying. We're not going to run out of cash. And so let's not give in here on these aggressive spending cuts that we've already passed a bill to get, and let's really hunker down here. So I don't know. You have both sides that are, very still kind of far apart conceptually. And I think another dynamic in play here is the fact that the House is scheduled to go on recess Thursday afternoon. And so, and look, the House calendar and Congress's calendar is something that's set, was set 6 months ago, right? Members have planned, this recess, and the recess is supposed to last until June 5th. So this is actually a fairly long recess. And what winds up happening during these periods is that congressional delegations actually make trips to various parts of the world during these, during these recesses. They either go back to their home district, sometimes they go abroad, sometimes they do fact-finding missions on behalf of the government, right? So, and these have been planned for months. And so I think there is a view inside both parties that's saying, don't make us stay here and cancel all of these trips. Now, look, you could say, oh, this is Congress, they don't want to work, these are boondoggles, whatever. It is what it is. These members, they have families, they have requirements, they have things that need to get done. And so if they're just going to be asked to stay in DC to vote on a bill that they don't really feel like they need to vote on because it's not an emergency, then you're really kind of pissing them off. And so and McCarthy has also said that he is going to abide by the 72-hour rule, which basically that was a requirement in order for him to be elected speaker, is that he will give everybody the opportunity to see any legislation for 72 hours before they vote on it. So we are getting to a point in time here where if they don't have a piece of legislation on the table today, tomorrow, the next day, and in that 72-hour window, nothing's going to be on the table for June 1st. And I think that is that's becoming your risk scenario. So even though I believe that June 1st is not in reality the X date, I'm not sure the market understands that yet. And so I think the headline that says Congress is going home for the weekend and a bill will not be on the table by June 1st actually becomes a risk-off event, because people are like, wait, you told me June 1st was a real problem. So I don't know. I know that's all the kind of long-winded summary here, but broadly, the dynamics are complicated. Political agendas are deep. It's not clear to Republicans that Yellen is telling the truth on the modeling. It's not clear from my analysis that I've seen that we're actually going to run out of cash very imminently. So I think both sides kind of hunker down, and we have some heightened maybe market stress and activity in order to either bring them to the table sooner, or we just kind of skate by and we get to the middle of June and then we're just, we're dealing with this later.
So if this is pushed out, first and foremost, what's happening under the surface also with the QT, with the Fed balance sheet runoff? Is this occurring simultaneously? They're still doing their $95 billion a month?
Yeah. The Fed is still doing their tightening. They're still doing their QT as if nothing has changed. And I think even if you look at the minutes today, obviously there was some reference to what should we do? Could we do anything if the debt ceiling is not resolved? There was some vague references to the Fed's financial stability mandate to make sure markets are functioning properly. But the Fed is still kind of operating as if this is going to be resolved. I think it's fair to say that if this is not resolved, it's very unlikely that the Fed is going to be raising rates in June, and the odds of a rate hike in June have come down, pretty nicely. I mean, so they're I think we're really only pricing in a 30-35% chance of a rate hike for June, but we are increasingly pricing out the rate cuts. And there had been some, Waller had given a fairly hawkish speech today where
skip and go.
I think the title was pause, skip, or hold, or whatever it was. But
I know,
really,
we always have these models of hike, pause, or cut. Now we have to add skip.
You have to add skip. But what he did say in there is that he does not believe there has been enough momentum on inflation reduction to suggest that we are at a sufficiently restrictive level on rates. And so he is not in the camp that we should be on a pause and stop. He is only really in the camp that if we pause in June, because there's some uncertainty about the data momentum, that we are likely to raise in July. We're leaning to a July raise. And so he's basically taken up the odds of a July raise. So now there's really a 75 or 80% chance, call it 75% chance of one hike either taking place either in June or July, which is, a far cry from where we were only a few weeks ago, where, folks were thinking possibly, certainly no hike in June, no hike in July, and cuts in September. We started to price that out a bit again.
So then getting to the data dependent part of this, is it May 26th? Yeah, we got PCE, right? We got April PCE coming in.
Yep, Friday.
That, Fed's official favorite measure. That's not likely to show any big or small, no progress, like no movement. It's just going to be sticky. So if we have sticky PCE, or even slightly accelerated in April, is that going to embolden the bulls to think, this is going to, the interest rate bulls anyway, that they're going to hike in July? I still see a pause, but I'm just asking.
Yeah, I think
the level here of?
This is really silly inside baseball stuff, but it seemed like from the minutes, some participants are more in favor of a rate hike in June, whereas several participants are looking more for a pause and think about this again in July. And as it turns out in the Fed's lexicon, several is more than some. I'm serious. But so it's unlikely that we would get a PCE number tomorrow on Friday that would, I think, really change that composition. I do think, though, that if we saw a very robust payroll number in June, so that's Friday, that's not this Friday, that's next Friday, June 2nd. If we saw that and we somehow got a debt ceiling resolution or kick the can moment for that, I think that would embolden the rate hike bulls to say, you know what, why shouldn't the Fed be going in June? If they're really saying that there's no significant progress on inflation, and employment is still very robust and wages are not really coming down as rapidly as they need to in order to justify 2% inflation, then why are we even pausing? And I think if we got into a scenario where they did pause, you in that environment, you would get dissents. I think you may even actually get a dissent from Waller. You possibly could get a dissent from Bowman, who's is a reasonable hawk. 2 governor dissents. I think that would be an issue for Powell. I don't think he would necessarily want that. So, but that's the data dependency part, right? That's the part where they need to see that labor data in order to get there. And look, they're also going to make a determination on the debt ceiling. If that where we are on that. So.
All right. So we don't really, I personally am not expecting any more than a pause, but that's since the bank bailout kind of drama. So this also percolating higher jobless claims is my kind of laser focus as it relates to not just the non-farm payrolls, but specifically the week after week on Thursday morning jobless claims. So we're getting dangerously close to percolating above a key kind of resistance area, for lack of a better word. And I think that's also going to put that pause kind of front and center. When we do, it is literally a June 15th announcement, right, for FOMC. That's a really perfect time for the markets, after digesting the past kind of 3 months of this debt ceiling drama, to sell the last rate hike. So I'm still in the camp that you've got that dynamic both in the market, but also in liquidity. Talk a little bit about the action that happens after the debt ceiling resolution, because we still have the issuance T-bills. Talk about notes and the whole thing of how this is going to likely roll out after mid-June, after this.
Right. Yep. So what's made this an incredibly challenging, trade setup macro-wise has been that there are these two, there's two dynamics at play here. One is this self-imposed constraint of the debt ceiling, which is something that only the U.S. and Denmark put on themselves. And it's a legislative thing that basically says we restrict our government's ability to raise more debt to pay its bills, just because we think that has some impact, or that should have some impact on what a government can and should be doing.
It's good for optics, when the powers that be aren't in power.
Look, I mean, and it's been going on. We've had it for decades. The debt ceiling resolution has been passed 70 plus times under both types of administrations. Divided government,
not following
consolidated
a
government,
historic bond collapse in 2022.
So this is the first dynamic in play here, and so a lot of this is: are we going to default? Are we not going to default? Are we going to run out of cash? Is the 14th Amendment in play? And these are things that are not, I mean, this is a kind of low, sharp, high degree of difficulty type trade here. And I think but if things go really badly and we take it to the brink, we saw what happened in 2011, markets were down 15% in 5 days leading up to the X date. Gold ripped, several $100s. And so there is a trade here if this goes really wrong. I think folks are starting to hedge for that. We're seeing that in some Eurodollar, in some SOFR trades and in some VIX trades. And so, it's becoming more of we need to protect against this, fairly outlandish outcome. But, most likely it's going to not happen. And so that brings us to the second part of the trade, or the idea, which is, I think, the bigger problem, and that is that we've been seeing massive liquidity injections in the first half of 2023, driven by the Treasury General Account being run down. That puts money into banks and financial players and citizens and everybody, and the Fed's emergency lending programs to save the banks also, added to reserves. And so there's been a significant liquidity injection in the first half of 2023. Once the debt ceiling issue is resolved, Treasury is then going to accelerate its issuance of securities. There was going to be a massive amount of Treasury supply, a combination of T-bills and duration securities of various lengths, in order to restock the TGA and in order to, pay bills for next year. And so Yellen has already said that she would like the Treasury General Account to be up at 600 billion by the end of the third quarter, and most likely up to, 700 billion or so by the end of the year. That is a kind of normal working assumption that they want to have. And look, since COVID, we've been running at various times north of $1 trillion or more. And I think depending on, what kind of debt ceiling extension we have, that will determine how much Yellen wants to, raise debt, because they don't want to get into the situation again where they feel like they're being held hostage by a debt ceiling. So there's going to be a significant amount of Treasury issuance. Where is that money going to come from? And at what rate is that going to come from?
To break down, before you get into the rate, cost of capital and funding, I read that it's about 733 billion of net new debt between now and end of September.
Yes.
Of this, about 75%.
Is bills.
Yeah, will be short dated T-bills.
Yep.
Mostly funded by pulling funds from RRP. So it's liquidity neutral, and it's not.
So that is
but the other 25 is a problem.
Okay, so I'll take the first part first, which is I disagree with the assertion that the money is just going to move directly from the RRP into T-bills. Right now, the RRP is a risk-free security that you lend overnight to the Fed, and you earn 5.05% annualized on that money. So at what rate is the RRP going to be drained in order to put that money directly into the Treasury General account? From my perspective, it needs to be at least 5.05% at this point. Why would I give the US government money for 4 weeks, 8 weeks, 12, whatever the duration is, at a rate that is lower than 5.05%, particularly if I think that the Fed is unlikely to be cutting rates this year? I have basic assurance that the RRP is going to remain at 5.05%. And if the Fed raises again, then the rate's going to 5.3%. So my view is that, yes, it's possible that the money will come from some of the money will come from the RRP and go into the TGA, in which case there would be it would be liquidity neutral, but it certainly won't be all of it. And it will be at a rate that is higher than the rate at the RRP. So Treasury is now going to be borrowing money at a yields that are higher than what you can lend to the Fed, because the Treasury is actually a higher risk than the Fed at this point.
Okay, so that has definitely not been talked about very much. So okay, so this is your but it's really just math. I mean, look, we're seeing the T-bill auctions right now. They're crazy.
Obviously, we just got a 21-day cash management bill that is debt ceiling related. That just got done at 6.2%. Today's 17-week auction just got done at 5.25%. There's been a 3-month that got done at 5.22% yesterday. A 6-month 5.17%. That was yesterday. So these are all rates that are higher than 5.05. Now we're going to talk about, and the issuances here are capped. Yellen's going to come out and say, now I'm going to issue another 500 billion of these in a 3-month period. Where that's net new issuance. The yields are not going to be lower than 5.05%. They're going to be higher. So if the money doesn't come out of the RRP, or not all of the money comes out of the RRP, it comes out of bank reserves. And so bank reserves are the main liquidity indicator. As bank reserves fall because the money gets moved into the RRP, that is the liquidity drain. That is the issue. And so here, I'll show. Let me just put this.
That's one issue, but then there's the other.
That's the issue. That's the variant view issue from my perspective.
I was about to say variant view issue.
The other issue is what you. Yeah, the other issue, what you mentioned, is the other 180 or 200 billion of duration, which is not going to come out of the RRP. That's going to come out of reserves as well. So
when you say out of reserves, that's out of the banking
system, and that's liquidity. That's a liquidity drain. It's basically money that sits in banks that can basically go to fund lending. It can go to fund investing. It can go to do anything.
And right now that's estimated to be 25% of the whole, while they're still doing the ongoing 95 billion a month in QT, in balance sheet reduction.
That's correct.
Okay. So when we talk about liquidity, some people don't understand, like I have my, net, selling net buying indicator that I use in my trading room, right? That really is very different than this liquidity, Fed liquidity that is basically either in reserves, not touched. If it was to come into the system, would be very inflationary. But the portion that is coming in and out for use in, banking, also speculation. So you're talking about right now this combined effort of not just the first tranche, the 75% of T-bills, but also the 25% of the notes and bonds combined with the QT is going to be a drama, and people are brushing it aside, that it's not to be dismissed. But the question is, would it happen? When will this happen? When is this issuance?
Let me share.
Like how soon after?
Let me just share my. Let me share my screen.
Okay,
I think it would be useful here. Hold on. Sorry. Your screen share is loading. Okay. All right. So just for so people can really see the dynamics in play here. This is a chart of the Treasury general account. Okay.
Yeah.
So this is dating back to 2015. You can see kind of what COVID did. This was, the government raised a lot of money. It's been drawn down. This was our debt ceiling issue at the end of 2021. It got resolved. The money got restocked. We went from, call it 40 back to almost $1 trillion, right? In the first 5 months of 2022. I'm not sure if you remember what happened in the market during the first 5 months of 2022. When the TGA got built, the market got destroyed, right? So, and that happened with rates still at zero. So what I'm suggesting now is that this is the TGA. It's at 76 billion. It's going to get very close to zero. Once the debt ceiling gets resolved, this is going to shoot back up over a 6-month period to somewhere between 700 billion and $1 trillion. And it's going to get done at now 5+% interest expense. So there's an impact there on markets, on valuation, on cost of borrowing for everybody that we should be discussing as well. So this is the reverse repo facility. Okay, so this is what folks are suggesting is that, hopefully you can see the screen here. And so this is the RRP, it used to be kind of a non-existent situation. Obviously, this is money now that is lent overnight to the Fed every day. This money is now up to $2.25 trillion. And the view, which you mentioned earlier, is that, well, this money is now just going to go from here and it's going to get cut back to here. And so it's going to be liquidity neutral from what I mentioned earlier about the TGA. Well, you can see like that didn't exactly happen during the first 6 months of 2022. So I don't know why exactly people believe that the RRP was rising in the first half of 2022, right? So why are we automatically assuming that the RRP is going to fall in the second half of 2023 as the Treasury raises money? I'm not exactly sure. But more importantly, this money is now 5.05% money. So there is an economic decision that actors need to make and say, well, do I want to keep my money here earning 5%, 5.05%, or do I want to give it to the Treasury? And if I want to give it to the Treasury, what kind of yield do I want? I mentioned earlier, I think it's going to be at a yield that's higher. So, and then here's kind of the punchline chart is bank reserves. So this is bank reserves. You can see here, this is COVID. Actually, you know what? Yeah, this is COVID, bank reserves fly. This is QT starts, right? This is, Fed starts its QT program, accelerates the QT program excuse me. Will taper. So we start to see it comes down. Then they start the program and it starts to come down. This is bank reserves. They fall very, nearly to below $3 trillion. This is SVB. This is the Fed reintroducing liquidity back into the system, in addition to the Treasury's general account being run down. So this is starting to come down again. It's back up now again because the Treasury is draining. I know that sometimes it seems backwards, but so my contention here is after the debt ceiling is done, this number here, bank reserves, is likely to fall by $500 to $750 billion over the course of the second half of the year. That puts us down to somewhere in the 2.5 to 275 range. If I throw this up against S&P, not to say this is the only way to look at markets, but there has been a close to 70% historical correlation, over the last few years between the size of the size of bank reserves and the S&P. And so right now, the S&P has already kind of detached from reserves. I know it's hard to see because it's small, but here, this is the orange line is S&P, the white line is bank reserves. My contention is that this bank reserve number here is falling to somewhere around here, which would intonate a sub 3,500 target on the S&P over the course of the second half of the year. That is the liquidity drain that we're talking about.
What was the target? 30 what?
I think if you think about 2.75 trillion of bank reserves, we're looking at a target of basically 3,400 on the S&P.
Okay.
So that's just from the US point of view. We also are going to have fairly sizable liquidity withdrawal now from Europe. The TLTRO, the TLTRO program has come to an end. The APP reinvestment program has come to an end. That had been kind of liquidity adds all of last year into the first part of this year. That may be another 500 billion of global liquidity that comes out of the system. So I think we had mentioned part of my issue, or part of what I got wrong earlier in the year, kind of thinking about US Fed liquidity on an island was missing some of the other factors of liquidity, as Europe had added liquidity, as Japan had added liquidity, as China had added liquidity, that had helped global markets. So now the US
and
will be
swaps. Yeah.
Right. So now the US will be in the second half of this year firmly contracting liquidity. Europe is firmly contracting liquidity, and Asia, is being now asked to kind of make up the difference and then some. It's not likely. It's not really possible. And neither Japan or China have suggested that that's the path that they're likely to go to. So if we get these sizable liquidity withdrawals, we are going to have a risk-off market. And
unless the Fed pivots, or I should say it's more than pause, cuts and or ends QT temporarily.
So look, I think we need to just think about these things in sequence, right? We think about this debt ceiling is kind of phase one. Phase two is this anticipation of massive liquidity drain and treasury supply at higher and higher interest rates that has an issue about crowding out borrowers, a global rise in the cost of capital, likely to hit asset valuations, likely to be a problem. And then at the point of time when it becomes a problem, that leads to inflation expectations plummeting, that leads to treasury market dysfunction, that leads to some broad issue, then the Fed will come in and say, okay, enough's enough. We're going to cut rates. We're actually going to take the RRP down, right? We're going to cut rates by 25, 50, 100, whatever the numbers are. Yep. Take that money that's sitting inert in the RRP, get it back into bank reserves hands, get it back into the economy. And hopefully they're able to do that without kind of inciting further inflation. So that's kind of trade three, right? But I think we got to get there first. I think we need to have this
without
risk off.
inciting inflation. We'll see it in oil first, most likely, but further down the line. When do you think that happens? When they try to, juggle the spinning plates?
I think I think the third quarter of this year is, a nightmare quarter. And if it leads to enough of a move in risk assets, in credit spreads, in worries about the U.S. government's ability to fund itself, and we have a 20% drawdown in equities, which 3,400 would kind of suggest, then the Fed will be kind of brought back to the table to be cutting rates. And is that going to be a year-end rally that's led by dollar weakness, commodities up, and a shift from growth to value? Probably, possibly. I mean, it's kind of almost too hard to forecast that out. That's phase three. And so as we're kind of going through phase two of this higher cost of capital worry, then we can start thinking about, well, what's the resolution here? How is the Fed going to get out of this? Is there a situation where they really can't get out of it? They cut rates and inflation hasn't really fallen. Then what happens? Look, as interest expense for the U.S. government goes up, there's an argument to be made for the fact that money just goes into the system, right? And so higher yields, higher interest paid, more spending, government outlays are moving higher, deficits are growing. Nominally, it's good for growth, it's good for it's good for employment, it's good for inflation, but it's not. It doesn't solve what the problem that the Fed says that we have is an inflation problem. So if they're cutting rates later this year because the government can't afford to borrow at such high levels, This is kind of it's a potentially scary world where oil gets repriced materially higher, gold's priced higher, and
but I do not mean to be lib, but it is a tomorrow problem, meaning NVIDIA just reported, right? They're up $50, 18%. So it's going to provide those of us who are bearish looking for, right, that rotation out of growth into value, or just pure undiluted volatility coming into the mid-June timeframe based on the liquidity extraction. This NVIDIA is providing us with stunning exit liquidity. Look,
I mean, there's been a huge disconnect, right, between, I think we showed this, I've tweeted this, but just there's a kind of, as real rates have risen, that typically have been a headwind for Nasdaq and for duration and for stocks, and that's been disconnected by the AI trade. And my negativity on equities, let's say, is not a negativity on Nasdaq right now. Like that's not how I've been playing. I've been playing this through small caps.
We are shorter time frames, and this is very tough for a lot of people to understand, but I want to clarify that. So, offering this kind of macro to micro advisory service and support business is very much looking at the macro event risk as it relates to inflection points, but also changes in policy and liquidity as it relates just to the model of market direction, not just for portfolios that are entrenched and how to defend, but also capturing all these counter trend moves in swing, actionable trades. And of course, I mean, that this is hard for some people to believe because they have only a myopic view on one particular time frame. And you and I operate on the same way, but in more granularity to the macro. I use it as a backdrop, but for me, I see the intermarket telling me that we're getting to these really big inflection points where we're going to have this reversal. So I'm looking for the narrative, and you're providing it in the form of your detailed analysis on the liquidity come mid-June. So the question by Jeff, how soon the liquidity draws down after the debt ceiling? Is it Pavlovian? It's like right away the market will start to reprice, or is it actual delayed? So we'll get closer to that. But for right now, do you have a kind of I just have mid-June.
So, again, unfortunately, it depends on this debt ceiling resolution. I mean, there is an environment where my view that we kick the can for another 6 weeks does actually play out. Mm-hmm. And so we're still dealing with, a treasury that is operating with very low cash. And we're dealing with a Fed that thus has kind of kept itself more on hold than not. So liquidity is not being further drained. And if liquidity is being further drained, but it's not being restored. It's not being step back. Liquidity is the TGA is basically flat at 50 billion. It's not rising back up because we can't raise the debt. So that liquidity is not being drained yet. Nasdaq could keep going, right? And that's your maybe that's your blow off top phase. If we don't have a debt ceiling resolution imminently, Nasdaq does its blow off. Maybe into July 4th, into the early, second week of July or third week of July, and into, earnings expectations. But I do think once we get this debt ceiling resolution, the supply from Treasury does start immediately. Okay. It's not like hey, tomorrow we're raising 100 billion, but it's Treasury will bump the sizes of the auctions. They give plenty of guidance about this, and we already kind of know the calendar. So they will start to refresh that account. So unfortunately for traders and investors, it's hard to know because we really do need to figure out the timing of this debt ceiling. That is phase one of this. That is an imminent issue. And for those who just kind of don't want to be bothered with it and just want to, say this is too hard for me to get and understand, I'm just going to focus on idiosyncratic single stock ideas. There are trends, there are trades.
Oh my God,
you talk about them every day.
oh my God, there's so much fun. Oh my God.
And we could keep playing, and you could keep playing them. That's not for everybody. But for folks who want to do that, then there's plenty to do.
Moving. There's so much moving. There's no lack of movement under the surface, but we're talking obviously macro to micro because a lot of folks want to understand what the risks are, big picture, and quite nervous about that. I want to kind of transition a little bit from the overarching macro, and you did an excellent job of explaining the mechanics, the plumbing of this debt ceiling risk being pulled forward, especially with, you just said Congress going on break Thursday evening. Until when do they get back again? What date? June something?
I mean, they're technically would come back June 5th, which is that month. So, I mean, the Senate is supposed to be around, but the House doesn't. But we'll see. I mean, I suspect that calendar will be fluid. It'll change if they get to something that they
and so is the dance with the market. So we have obviously still been in trend, pushing higher into that, SPX gap fill, and then 4,300, which has been kind of baseline bet for me since that bank bailout on March 12th. But first and foremost, while we have been pulling up in markets, I want to kind of transition to intermarket and show, this is what I show with clients, obviously. So this is kind of helping me from a trend standpoint, stay in a particular direction. It does, and you can tell this particular chart on a monthly, combine that with the macro backdrop of being aware of when economic data is coming in, whether it be payrolls or, CPI, or of course, Fed Day. And this right now is debt ceiling drama discussion. But this is really just something that helped me identify back in, after this 13 years of outperformance in Nasdaq. This is a Nasdaq to SPX ratio. I'm crazy for ratios. Anyway, it looked like we were going to start to roll over. We started to dissipate in the 2021 timeframe, and then we absolutely looked like we were going to roll over November, December, and then January 2022. And then we had that 35% drawdown. In this little blip over here, if folks can kind of see this, we had what later amounted to $1.5 trillion in liquidity by coordinated central bank intervention. So we had Treasury. Remember the gilt blowout that happened September 22nd. Yen did an intervention there. Also, that was a phenomenon in regards to the interest rate volatility world. But the point is that then Fed came in, also Bank of Japan came in. China ordered their state banks to buy Chinese equities. We did dollar swaps with Swiss National Bank. It went on and on and on. Long story short, after all was said and done, Matt King of Citibank, counted it up and said it was $1.5 trillion. So this monthly chart, just as an example, has now moved right up into the underside of this very long, right, since 2009 channel. And this was the 2000 top. So I've used this as kind of a way to gauge this momentum bigger on a counter trend, right? So this was it. We're done. The top was in. we fell 35%. We got absolutely defended. We had the January effect. We had the bank bailout, loose monetary policy. It floods in, right? All this TGA drawdown. It just helps the risk assets. No question about it. And it was coordinated, not just here, but Japan, China, et cetera. So long story short, this is where we are. This was just taken on the 21st of May. And I've got another one for semis as well. So we got a potential, in head and shoulders as a reversal signal. This is SMH, by the way, to SPY. I'm wrong if we get above and continue. And I absolutely can also respect the fact that if this indicator gets above this channel and we're in the channel, it's a strong bullish, impulse. There's no question. Right now, we're at the channel. So it's not the end of the month. But my point is when Craig is talking about, it's really tough to time right now the macro outcome, because so much is dependent on this, political dysfunction. In the same way that tech has been this risk aversion trade, and not even risk on, just, the concentration that has been in AI themed and mega cap tech and nothing else. Otherwise, it would be flat year to date. So the point is we're right at an inflection point for tech, which is Nasdaq to SPX and SMH to SPY. We're going to have, of course, rotation underneath the surface. Right now, we've been spying this kind of rotation as it relates to growth is petering out, and we should get this to pull back a little bit. Obviously, on NVIDIA having its surge after hours. It's going to help bid up the market. And it was good, by the way, because I had mentioned even in Twitter, I said, brace for impact if we don't get defended here, both bonds and equities. And immediately we got defended. Literally, it was ironic, one minute later. But the point is, we got defended. We spiked higher, that lovely stick save, running into the NVIDIA earnings. We'll move higher. Hopefully, we will tag that weekly gap down of 42.1870, and then maybe we even, you can't see this very well, but maybe we even, this is, by the way, 4,300, right? This is kind of like a wedge for SPX. We've already done this where in the Qs we broke out, we hit 338, we came back down. Maybe we do this with SPY, yes. So SPY in the next month. My point is that we've got no lack of short-term kind of climb a wall of worry. We've got a technical range that has not broken as it relates to SPY or the Qs. Small caps are definitely on the floor. They have been on the floor. We had a very decent Q2 as it related to company profits withstood higher prices with higher prices. And the dollar really did not get in the way. It has still been very much in a channel of chop, big picture, with yields. Now, if that changes with the debt ceiling and we get a spike higher in dollar, which is our baseline bet, we get a spike higher in yields, which is our baseline bet, then all bets are off as it relates to bonds, right? Because bonds will start to break down and we will have equities follow in earnest. And all of this is against the backdrop of global, liquidity, but in particular, Fed makes the weather, and we are going to have this pullback in liquidity starting in the mid-June through September timeframe. It makes Q3 very dangerous, and that was really the major kind of summation I wanted to get at before answering some questions. And then the final one, which is the big unknown, but not really to me. I see unemployment claims moving higher, and I think we're very, very close to spiking above a key indicator that I use, and I think we're going to have risk off when we do. Like last Thursday, we had jobless claims come down. I don't have that chart right in front of me, but the point is jobless claims came down and markets spiked higher on Thursday. So we'll see what tomorrow brings. I think that's always, at least right now, kind of my biggest worry as it relates to when we're going to trigger volatility. In the meantime, these are just kind of, fun counter trend moves. Alexander asked about gold. He knows because he's a client. I had posted trend long gold silver miners, a while ago. Actually, it triggered in September, October. This is bullish percent index for gold miners, but I actually didn't have confirmation that I trusted until about December. And then it had continued higher, and we're talking GLD, SLV, GDX, or just straight gold. And it definitely started moving higher. And then I said, careful, I think we're going to get a pullback. And Alexander, this is for you. Hopefully you can see this. We definitely have some digestion here after a very nice pullback. But Alexander is asking a question, what about gold in the debt ceiling? And there's another chart I want to show you in regards to gold. Just one second, this one. I show this every day in my live trading room, which is basically the dollar yen moving higher, which was my baseline bet. We were going to percolate up to this 139.5, and it would be pretty quick after we got above 137. We have done that. And that we would come back down to 1960, but I actually think that we've got a little bit more to go south in gold, but not for nothing, but gold should be a really good short-term hedge into a debt ceiling drama. What's your view on a gold trade? Even though we're just kind of chopping around the past 5 days, it definitely has come down very, very nicely as the dollar yen and dollar yuan have moved higher. I don't have a problem with gold as a trend trade, but I still see it in risk off, distribution mode lower. But once it comes to debt ceiling keywords, what will you be looking for to pick gold back up again?
Yeah. I'm sure you're not going to love hearing this, but unfortunately, this also just has let me show my screen here. But one second, it really, again, depends on the debt ceiling resolution. Back in 2011, when we got to the brink here, gold really, outperformed in a very sizable way, kind of into that debt ceiling and even kind of beyond it. And I think as we get closer and closer to the brink of, a potential for a U.S. government default, gold's going to get some flight to safety, bid to it, likely, ironically, alongside with the dollar too, which is a bit ironic, silly, but that's what happened in 2011. On the flip side, once we get to the other side of the debt ceiling from a short-term perspective, you lose that need to hedge. The government hasn't fallen apart. And so what bears will say is this chart which I have here, which is the white line is gold and the orange line is real yields inverted. And so what that means is that as real yields rise, typically, which would be the orange line going down, gold typically falls, right? And so you can see, and as real yields fall and get increasingly negative, that's been very, historically bullish for gold. So a lot of gold bears see this gap as a potential for a sizable gold correction after the debt ceiling is resolved, because people believe, well, really gold's only been rallying here because of debt ceiling, because of banking issues, the SVB issues, some incremental Fed liquidity. And so once we start to remove all that, gold's going to fall. I do think gold will have a correction once the debt ceiling is resolved, but I do think this chart is instructive. And I think that there's more in play here than just gold safety bid on some of these issues. And what I think is happening is that from a long-term perspective, the U.S. Treasury bill or 10-year bond is losing its role as an exclusive neutral reserve asset, and gold is becoming more a part of the picture, right? I mean, central banks have been net sellers of treasuries for the last several years and have been net buyers in size of gold. China is setting up an alternative system of trade away from the dollar, away from treasuries, using the RMB, settling in gold. Russia's doing it more so when they're selling energy because they have to, as they've been kicked off of SWIFT and have sanctions. India's talking about it. Brazil's talking about it. More and more countries are talking about it. And since pricing is set on the margin, we don't need the dollar to lose its hegemony overnight and be replaced by something. It's just the fact that it is slowly getting taken out of exclusive its exclusive role that matters. And so I think that's what gold is being reintroduced into this global reserve system. That's part of the reason that I really like it. And then as we get to that point, which we talked about earlier from a phase 3 perspective of this trade, when the Fed is finally forced to say, okay, we need to cut rates, the economy has slowed, or the borrowing costs for the government are too high, that incremental liquidity finally comes back into the system, gold's going to reset higher on that. So, it's one of those things where you want to be.
Gold loves loose monetary policy.
Yeah, exactly. So I think from it's hard to kind of nail every iteration of this, but it's you want to be there now for gold as a hedge in case things really get screwed up here for the debt ceiling. Then you kind of want to not really be there. Maybe you sell calls against your position or something to kind of keep yourself in there, but you can maybe, hedge some of that downside. And then as we kind of push through the summer into some of this risk off period, gold will anticipate the eventual Fed liquidity addition again that is needed. And that will be the next move higher. And then when gold kind of retakes its all-time highs, I think it's going to run hard.
Okay. Yeah. So that's why we say it's a trend trade since December, but it still will succumb to the ebbs and flows of this market liquidity. And in particular, right now, I can show you this, which is hold on. There we go. All right. So the dollar, since we were just talking about this strongly, this is, Dixie on a weekly and a daily, and you can kind of see where all this central bank definitely coordinated globally, and lots of intervention that helped very much pressure dollar and yields. And they are obviously a headwind when they rise, which is why we had a little bit of a tussle the past few days, which is great as it relates to two-way market, because it was getting really boring in an extremely tight range. So, contraction leads to expansion, but this dollar is definitely still big picture, just kind of like in a box. So we would have to get and push above 105, 106 area to be really very, very risk off, in my humble opinion. And so we've got some time to get there. But in the meantime, you're talking about the risk off, like what happened in COVID, where both gold and dollars spiked higher, knee jerk first. And then once the liquidity came in, they crashed very, very strongly, and kind of, stayed low during, let's see, from September 2020 all the way through until basically this past December. So they just started getting lifted up again with the bank bailout. That definitely helped drive that for a few weeks, but then it petered out and has also come back in. So that's the ebb and flow. But the other one was the bonds, right? So we've got this, speaking of, weekly chart and also, daily chart, we've got bonds on a very strong weekly trend line, needs to get supported, and it did. But if it breaks, we're definitely going to have some more volatility introduced to the market. But this, literally this afternoon, it did get defended, both stocks and bonds, and moved higher. And this is some of the stuff that, just to kind of do a quick intermission, and then I'm going to go right into lots of questions. We go through this stuff every single day. I have a live trading room, and I want to just kind of introduce you to that, because James, who has helped us put this whole thing together, is reminding folks that we actually have different products, a community for beginners in the most part. Mine is very much kind of intermediate driven and chase swing and trend time frame. Craig, obviously, with the macro in Edge. This is actually a club offer for the summer, and I definitely want to introduce you to that if you're interested in live trading room, and lots of contributors, including your Slack channel, Craig. But that's very different from what Craig does every day with his concierge service of macro advising, which is to provide that bespoke and pro-to-pro contact. So this is what I provide right here. And then I actually hit Craig up and say, translate this for me, right? Like this is I'm looking for the Edge one. This is my baby. And then you're working with clients to try and translate the macro event risk, and then also positioning and the pair trades and the currency and all of that stuff. So talk a little bit about how this, for you anyway, in regards not just to the market commentary, but then I share mine, you share yours. We get tighter in our timing also of helping clients and supporting clients, because we're kind of bouncing off these ideas. I think it's extremely helpful, makes me definitely a better analyst. And then I'm taking these ideas as positioning, right? Like, how is this going to, how do we hedge this portfolio risk if we have this macro turn in June? Or what am I looking for, obviously, to help clients? I have a SPX roadmap, but I'm also looking for the risk factors that come in. So you're helping with that very much. And just a reminder that we have an Edge pricing, which is greatly discounted, and there's a 7-day trial as well to come in and work with Craig and do this day to day. He's extremely responsive. So I just wanted to kind of do that intermission before we get into any more talk about, or any questions and any other talk about the macro and the micro. But we do have some questions out there. So anything else in regards to gold, or, oh, here's one from Dan. I hope I answered the question for Alexander. I think it basically was, we get the point, it's trend long. Craig is more gold bullish. You just explained that detail, but how do you reconcile the pathway? Since, for example, I am swing short right now, right? And I've been on record with that for a few weeks, that this was in complete support of a rising dollar yen. and that we would have pressure on precious metals, reflation trades, yen, as well as bonds, and that has worked. So that's my my swing time frame, and I'm going to be looking for support when it's time to really take care and cover those shorts, because we're going to get to a place where the debt ceiling is going to come in and it's going to pop up like a daisy. So how do you reconcile, Alexander's asking, between my maybe shorter term views and your longer term views? How do we help clients with that?
Yeah, look, I mean, I think when you and I get to similar conclusions coming about things from a different perspective, that typically leads to very outsized returns for folks. And I know we've been doing this together, me starting as a client, several years ago. But so I like when I have my view of the world, how I think things are going to play out, but I use you as a sounding board from the charts and the intermarket stuff to help with position sizing. And I think that's really the key here. I don't want to be really shaken out of positions, because particularly for something like gold, where I think there is kind of tremendous upside and potential, where gold is reintroduced in a big way to the financial system, and there could be 50 to 100% returns in gold, and 5 to 10% downside. I don't want to get shaken out for that kind of small move. But when we're articulating dollar strength, and we've been talking about that, and you're seeing that, and you're saying, I think gold's a short here. That's an opportunity for me to reduce the size of my positions, to protect against my position, because I manage my own money. I don't manage a fund. I manage my own personal accounts, and I have a longer term perspective on my capital, and I don't want to get shaken out. And so I use the timing tools as hedges, or as ways to reduce sizes, or to option adjust my positions. And I think that's how we kind of work well together. But I think at the point in time when your indicators then line up with my view, then I feel like it's time to size up. And what I notice, what typically winds up happening is I typically kind of get to things before you do. And it's not that it's a knock, but it's more like, okay, I'm thinking this is coming, and you're saying, I hear you, Craig, but my indicators aren't there. And then I'm there for the turn, and you're there. I
swamp you with questions.
Yeah. And then you're there.
I see it too.
And then once you're there, it's not that we've missed any. Maybe when you get there, you've missed the first inning of the move, but then you catch innings 2 to 8 as good as everybody else. So that's the
understanding of it. Yeah. It's the understanding of it, and that translates to conviction. And so together we have that. Yeah, it is very yin and yang. The macro to micro, I use a backdrop to get to the micro. You're using solid macro, and I really respect that. So this is the challenge, though, when we're asked about, for example, energy, right? This is a question that comes up a lot. When will this transition toward energy commodities be? Because right now, obviously, reflation trades are still under pressure. And I am of the opinion that it's not ready yet. I am absolutely looking for the triggers, but they have not triggered in my system at all. So when they do, I will be very convicted and let clients know. But you're looking at it down the pike, 6 months, 12 months. These are the deficiencies that we have, and they will have to get addressed. Position a little bit now, you go in a little bit early, and then you are solid when it takes off. I wait for it to take off.
Yeah, look, I mean, I'm intellectually interested in kind of having a view of how I think the world's going to play out. It's what I've been doing for 20 something years. I like to do it. It's not always right, but it's what I want to do with my life and my time. But there are certainly times when my thoughts don't work, or they're early. And so having another set of eyes that looks at things from a different perspective that could help with that timing is of great value. And so these thoughts about energy, commodity inflation, I mean, that it's at some point. The question is, when is that point? Everyone wants to know. And so that's when we can use the intermarket tools and the like to kind of nail the timing of inflection points. And so, yeah, I'm a long-term oil bull, sure. So a lot of people are. I'm a long-term copper bull, but these have been under tremendous pressure, all year as the dollar has rallied, as the China growth story has underwhelmed. And so you could be a structural oil bull and be missized in your positions and get carried out. And so that's
we're not Buffett, who says I may not get super rich from my energy holdings, but I will stay super rich.
Right.
But the point is, we definitely share that intellectual curiosity, and we love this puzzle of the market. There's no question about it. And then, of course, like I said, every day we are going through all asset classes and different timeframes, because clients have a different let's say appreciation for risk, and everyone's different. And so we're providing a lot of customization to give them what they need, where they're at. And I think that's definitely a differentiator as well. I think we definitely are over the power hour time, and I wanted to just thank everyone for joining. We definitely have an opportunity to come together and share some of the insights and also the analysis of how we are trading these major trends or the risk that is coming into the market. Some of these moves are not done. NVIDIA providing extra liquidity, for example, is part and parcel for the course. And when they are at inflection point and then trigger and turn down, I will let clients know. And so we'll Craig, and we definitely invite you to join and check it out. So again, Craig's product has a special at $6.99, and it is a 7-day trial. So definitely check that out, or email james@LaDucTrading.com for more details. And right now we have a summer special, Memorial Day weekend, and then we will just do our best to navigate the chop of the markets and figure out next steps. And then, of course, we'll be back, let's say, a few weeks. We'll do this again right during all of this drama after Congress comes back, because they're likely not going to do a dang thing by Thursday night.
Yeah, I'll be working next week. Congress might not be, but I'll
We
be
all
there.
will. We all will.
Yeah.
All right. Thank you so much.
All right.
Bye.
Thanks. Bye.